Hello and welcome to PPC Money Matters, a channel that covers everything regarding stocks and investing, personal finance, and opportunities as a self-employed in the finance industry. I'm your host, Finn. In today's video, we are going to discuss the shocking collapse of Credit Suisse, one of the largest and oldest banks in Switzerland, and how it was rescued by its rival UBS in a historic bailout, and how investors, particularly the Credit Suisse stock and AT1 bond holders, were affected by this rescue. Credit Suisse was founded in 1856 by Alfred Escher, a Swiss businessman who also helped build the country's railways. For over a century, Credit Suisse was a symbol of Swiss banking excellence and stability, serving clients from all over the world. However, in recent years, Credit Suisse faced a series of scandals and losses that eroded its reputation and profitability. In 2021, Credit Suisse suffered huge losses from two investment funds that collapsed, Archegos Captial and Greensill Capital. Archegos was a family office run by Bill Hong, a former hedge fund manager who had been banned from trading in the U.S. for insider trading. He used massive leverage and complex derivatives to bet on stocks like Viacom, CBS, and Discovery. When these stocks plummeted, he couldn't meet the margin calls from his lenders, including Credit Suisse. Credit Suisse lost about $5 billion from this debacle. Greensill was a finance company that specialized in supply chain finance, which is a form of short-term lending to businesses. It used a network of banks and insurers to fund its loans, including Credit Suisse. However, Greensill's business model was risky and opaque, relying on questionable assets and clients like Sanjeev Gupta's GFG Alliance, a steel conglomerate that faced fraud allegations. When Greensill's main insurer refused to renew its coverage, it triggered a liquidity crisis that led to its bankruptcy. Credit Suisse lost about $1 billion from this fiasco. These two events exposed Credit Suisse's poor risk management and governance, and led to the departure of several senior executives and board members. The bank also faced lawsuits from investors and regulators who accused it of negligence and misconduct. By early 2023, Credit Suisse was on the brink of collapse. Its stock price had plunged by more than 80% since 2020, wiping out billions of dollars of shareholder value. Its capital ratio had fallen below the regulatory minimum, putting it at risk of insolvency. Its credit rating had been downgraded to junk status, making it harder to borrow money or attract deposits. The situation worsened when two U.S. banks, Silicon Valley Bank and Signature Bank, also collapsed in March 2023, sending shockwaves through the global financial system. These banks were heavily exposed to the tech sector, which had been hit by a market crash and a wave of defaults. Their failure triggered a panic among investors and depositors who feared that other banks might be next. The Swiss authorities realized that they had to act fast to prevent Credit Suisse from going under. They feared that if Credit Suisse failed, it would have devastating consequences for Switzerland's economy and reputation as a global banking hub. They also worried that it would create systemic risks for other banks around the world, especially those with large exposure to Credit Suisse. The Swiss National Bank, SNB, which is the central bank of Switzerland, decided to orchestrate a bailout of Credit Suisse with the help of UBS, which is the largest bank in Switzerland and Credit Suisse's main competitor. UBS agreed to buy Credit Suisse for 3 billion CHF, about $3.3 billion USD, which was a fraction of its book value. The SNB provided UBS with 50 billion CHF, about $54 billion USD, in emergency funding to facilitate the deal and ensure liquidity in the banking system. The bailout was announced on March 16, 2023 as a merger between UBS and Credit Suisse that would create a new banking giant with assets of over 4 trillion CHF, about $4.4 trillion USD. The deal was hailed as a historic move that would save Credit Suisse from collapse and strengthen Switzerland's position as a financial center. The UBS buyout of Credit Suisse was a shock for the banking sector, as the Swiss authorities forced a merger to avoid a financial crisis. The deal was bad news for both shareholders and bond holders of Credit Suisse, who suffered huge losses. Shareholders saw their stock value drop by more than 80%, as UBS paid only 3 billion francs for the whole bank. Bondholders faced even worse consequences, as Credit Suisse's additional Tier 1 bonds were written down completely, wiping out 16 billion francs of their investment. The deal also raised legal and regulatory questions, as UBS had to terminate a previous agreement with Michael Klein to spin off Credit Suisse's investment bank. Credit Suisse's bondholders, who saw their 17 billion worth of bonds wiped out by the Swiss regulator FINMA as part of the takeover deal by UBS. These particular bonds were classified as AT1 bonds, a type of bank debt that can be converted into equity or written off if the bank's capital ratio falls below a certain level. They were introduced after the 2008 financial crisis to make banks more resilient and reduce the risk of taxpayer bailouts. However, they also come with higher risks for investors, who may lose their entire investment in case of a bank failure or takeover. FINMA said this was necessary to protect the stability of the Swiss financial system and avoid a disorderly resolution of Credit Suisse. However, some bondholders have challenged this decision and threatened legal action, arguing that they were unfairly treated compared to shareholders, who received some compensation in UBS shares. The legal basis for wiping out Credit Suisse's AT1 bonds lies in the terms and conditions of the bonds themselves, which allow for a write-off or conversion at the point of non-viability of the bank. The point of non-viability is determined by the regulator, in this case FINMA, based on its assessment of the bank's solvency and liquidity situation. According to FINMA, Credit Suisse was at risk of becoming non-viable due to its massive losses from the Archegos and Greensill scandals, which eroded its capital base and reputation. Therefore, FINMA exercised its discretion to trigger the point of non-viability clause and write off the AT1 bonds. In conclusion, the dramatic fall of Credit Suisse and the subsequent losses faced by its bondholders serve as a reminder of the importance of understanding the risks associated with different types of investments. The situation underscores that even well-established institutions can falter due to mismanagement or unexpected events. It is essential for investors and financial consumers to stay informed about the financial health and governance of the institutions they engage with and to be aware of the potential risks linked to various investment products. This awareness can help individuals make more informed decisions when navigating the complex world of finance. Thank you for tuning in to Money Matters, a channel brought to you by Pinnacle Personnel Consultancy. PPC is a dynamic and innovative company. We're committed to providing exceptional networking events and fostering connections within the finance industry.